Shalom YouTube. You're listening to The Financially Savvy Chick. So, the largest credit card user just got declined. And that user is America. The U.S. economy runs on credit. When America's credit engine sputters, so does the economy. And right now, we're majorly overdrawn. Banks are tightening lending standards for consumer loans, a reliable leading indicator for an economic recession. Over the last 12 months, the percent of U.S. banks reporting an increased willingness to make new consumer loans has plunged deep into negative territory. Banks are wary of making new loans right now because consumer defaults are on the rise. Consumers are defaulting on their loans. They simply just cannot afford to pay it back. Yes, it's not right to borrow money and not be able to pay it back. However, there are circumstances sometimes outside of your control that prevent you from paying back your loan. And this is the honest way I can explain this, such as job loss. That's the biggest issue right now. There are delinquencies, and the recent acceleration in delinquency rates on credit card debt is beyond ridiculously high. In the latest round of earnings calls, every major American bank reported a surge in credit provisions. Credit provisions is, simply put, capital set aside to cover future loan losses. For instance, J.P. Morgan reserved $2.3 billion for potential loan losses in the fourth quarter, a 49% increase from a prior quarter. That's almost 50%. Over the past year, inflation has eroded incomes. The consumer savings rate has plummeted to a record low of just 2.2%. In a recent survey, 64% of Americans reported that they are living paycheck to paycheck. This is becoming more common, and as a result, they've turned to plastic, racking up a record $930 billion in total credit card debt, by nearly $200 billion since 2020. We know what happened in 2020. But with defaults on the rise and banks pulling back on lending, this source of spending is now drying up. Typically, American consumers take out roughly $20 billion to $30 billion in new credit card debt each month. In December, that figure fell to just $7.2 billion. Fewer loans and fewer credit card means less spending, and corporate America is feeling the pinch. S&P 500 companies are on track to post their first negative quarter of earnings pre-share growth since the pandemic crash. What's more, the consensus estimates for the forward earnings of the S&P just turned negative, which is a rare occurrence on permaball Wall Street. But when it happens, it usually precedes a steep drop in stock prices. Despite the recent rally in stock prices, the key leading indicators of economic growth at all points towards a sharp recession looming on the horizon. This does include rising default rates, tightening credit, and deteriorating corporate earnings. We all knew that stock prices were going to rise, but it took a 10% layoff. That was the main key. The only question now is whether Jerome Powell will accept the short-term economic pain of a recession to stamp out inflation for good. The alternative path of easing rates too soon risks a repeat of the nightmarish great inflation of the 1970s and a lost decade in economic growth and financial asset prices. All things being equal, we'd rather deal with a sharp one-time recession than another 10 lost years of inflation. But the ball is in Powell's court right now. We know that Powell said his target goal is a 2% inflation rate. 2% inflation rate means unemployment needs to increase to bring the supply down, all right? The Fed, like Mary Poppins, never explain anything, or if it does, it always open to interpretation. Only Powell knows his own intentions. Meanwhile, investors need to focus on building a portfolio that can withstand a range of potential outcomes. Focus on defensive, capital efficient names, okay? And get broad exposure to commodities and energy in particular. You basically want to find high income securities. High quality energy companies can offer both offense and defense in a portfolio. In a recession, the current trend of underinvestment in fossil fuels should accelerate, boosting energy prices for many years. You pretty much want to protect your investments right now, and what you want to do is look into tangible assets. Silver and gold has always held its value. 1 ounce of silver is equal to 1 ounce of silver. $1 is not even worth $1. So I'm gonna leave that at that, because I'm not a financial advisor. I'm not giving you advice. I'm just telling you based on my own research and proven through history that silver and gold have always held their values. I hope you found this video helpful. Please hit the like button. Please share this video so that others can be made aware. I hope you are paying down your debt, and most importantly, staying out of debt. Don't forget to check out our website, financiallysavvychick.com, and head over to our blog section. Until next time, shalom.